How to start investing money for the first time. Investing your money is the most reliable way to build wealth over time. It's time to make your money work for you. Before you put your hard-earned cash into an investment vehicle, you'll need a basic understanding of how to invest your money the right way. To figure that out, you'll want to consider your style, your budget, your risk tolerance. The investing world has two major camps when it comes to the ways to invest money: active investing and passive investing. Active investing means taking time to research investments yourself and constructing and maintaining your portfolio on your own. To successfully be an active investor, you'll need three things: time. Active investing requires lots of homework. You'll need to research investment opportunities, conduct some basic analysis, and keep up with your investments after you buy them. You'll need to research investment opportunities, conduct some basic analysis, and keep up with your investments after you buy them. Knowledge all the time in the world won't help if you don't know how to analyze investments and properly research stocks. All the time in the world won't help if you don't know to analyze investments and properly research stocks. And since passive investments have historically produced strong returns, there's absolutely nothing wrong with this approach. Active investing certainly has the potential for superior returns, but you have to want to spend the time to get it right. In a nutshell, passive investing involves putting your money to work in investment vehicles where someone else is doing the hard work. Mutual fund investing is an example of this strategy. For example, you could hire a financial or investment advisor, or use a Robo Advisor to construct and implement an investment strategy on your behalf. Passive investing: more simplicity, more stability, more predictability, hands-off approach. Tax advantages: active investing: more work, more risk, more potential reward. You do the investing yourself, or through a portfolio manager. You may think you need a large sum of money to start a portfolio, but you can begin investing with $100. The amount of money you're starting with isn't the most important thing, it's making sure you're financially ready to invest and that you're investing money frequently over time. All investments, whether stocks, mutual funds, or real estate, have some level of risk, and you never want to find yourself forced to divest, or sell, these investments in a time of need. While this is certainly a good target, you don't need this much set aside before you can invest. The point is that you just don't want to have to sell your investments every time you get a flat tire or have some other unforeseen expense pop up. Think of it this way: the stock market has historically produced returns of 9% to 10% annually over long periods. If you invest your money at these types of returns and simultaneously pay 16%, 18%, or higher APRs to your creditors, you're putting yourself in a position to lose money over the long run. Each type of investment has its own level of risk, but this risk is often correlated with returns. It's important to find a balance between maximizing the returns on your money and finding a risk level you are comfortable with. For example, bonds offer predictable returns with very low risk, but they also yield relatively low returns of around 2 to 3%. Even within the broad categories of stocks and bonds, there can be huge differences in risk. For example, a treasury bond or AAA rated corporate bond is a very low-risk investment, but these will likely have relatively low interest rates. On the other hand, a high-yield bond can produce greater income but will come with a greater risk of default. One good solution for beginners is using a robo-advisor to formulate an investment plan that meets your risk tolerance and financial goals. In a nutshell, a robo-advisor is a service offered by a brokerage that will construct and maintain a portfolio of stock and bond-based index funds designed to maximize your return potential while keeping your risk level appropriate for your needs. For example, if you have a relatively high risk tolerance, as well as the time and desire to research individual stocks, and to learn how to do it right, that could be the best way to go. If you have a low risk tolerance but want higher returns than you'd get from a savings account, bond investments, or bond funds, might be more appropriate. If you're like most Americans and don't want to spend hours of your time on your portfolio, putting your money in passive investments like index funds or mutual funds can be the smart choice. And if you really want to take a hands-off approach, a Robo Advisor could be right for you. Index funds. This popular investment vehicle tracks a market index and can help balance your portfolio. ETFs. Learn about exchange-traded funds, or ETFs, which trade much like stocks,